Hello everyone, and welcome back to my channel. My name is Kevin Holcomb, and in the last 9 years I have been in the mortgage industry, currently working as a loan processor for a branch. And today I wanted to talk about student loans and how we look at them when we are looking at your profile for buying a home. So here we go. So today I wanted to film outside because it is breathtakingly, wonderfully gorgeous and cool with a nice breeze. Figured, why shoot inside when outside is so nice? So what I wanted to talk about, as I mentioned before, is student loans. Now, if you're like me, you might have some student loans. And if you're also like me, your student loan payments may have been zero for the last, 2 years or so. It might have been in deferment. So how do we look at those when we're pre-qualifying you or we're pre-approving you? So if your payment has been zero, how we look at that on credit is it'll actually show whatever your loan balances are for all your different student loans, and they'll show zero as the payment. Now, you might be paying on them, it doesn't matter. What it's saying, the credit report is saying, is that yes, this debt is owed, but it's showing zero. So when you are looking to use conventional financing, FHA, VA, they all have similar guidelines as to how that kind of debt is treated. Now, like I said, it has to report zero. So if it reports a different number, usually we go by what that number is, even if it's not a fully amortized amount or something along those lines like a car payment would be. So whatever that is, we have to go by it. But if it does show zero, usually we're looking at 1% to 0.5% of your total loan balance is being calculated as what that monthly payment would be. So if you owe $50,000, I believe 0.5% of that would be $250. So 0.5% of that total balance, $250, that's what we actually have to count against you for your monthly payment. Now, if it's 1%, so like with conventional, I believe it's Fannie Mae, so it's conventional loan, but it's going to Fannie Mae, then it has to be 1%. If it's 1%, then we have to hit you with $500 a month as a monthly payment. That alone can be enough to pretty much take you out of the game to be able to buy a house. So we'll usually look at like Freddie Mac. So if we have a conventional loan that we're going to be sending to Freddie Mac, and your loan officer is the one that knows this, controls this, then we're going to look at 0.5% of all those total loan balances. So what if you have 20 different student loans? We're going to look at 0.5% of every single balance and hit that as a payment. If it's one giant lump sum that's sitting there as one account, which is how my student loans actually appear, it's just one big loan, we'll take 0.5% of that one. And that's how we look at it when we're qualifying you. So how does that work when you're getting it pre-approved? Well, we look at the total of all of your debts that are as reporting on your credit report, and all those minimum payments, and those are basically counted against your income, and then they're counted against your income plus what that new payment would be on a mortgage. It's not just the mortgage, but your total monthly payment on the house. So PITI, your principal, interest, taxes, and insurance, and then if you have a homeowners association due, we include that. But we have to balance these numbers against each other. So gross income versus your debts versus that proposed payment, that gives us an idea of how much you can qualify for, how much you'll need to come in with for down, all of those things. But that's how we deal with them with student loans that are at zero. So just wanted to kind of put that out there. A lot of people have student loans. A lot of people want to buy houses. It can be prohibitive, but it just depends on your loan officer and what they're looking at doing. They can kind of find the best way to kind of go about that and help you out as best they can. So there is some more nuance to these. There could be, you have to get documentation from your servicer as to what your payment is going to be. You can use that documentation because sometimes that'll be a lower payment than using 0.5% of the balance. Sometimes, so you might have to get your documentation. But if not, they're going to use just that general figure there. So if you have any questions, go ahead and leave them down below. If you like this content, please give us a thumbs up, subscribe to the channel if you haven't already, and I'll catch you next time. Peace.